أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. So we'll continue chapter 14, the third part, which is the auditing of the property, plant and equipment, and we're going to discuss the property, plant and equipment in general, the types of transactions the client has, the segregation of duties and the reasons for those segregations, and then we're going to discuss the inherent risks associated with them. For auditing purposes, the control risk is taken care of when we do the purchasing, so we're not going to discuss them again here. And then we have the substantive analytical procedures, so we're going to discuss this, and then Sunday inshallah we'll discuss the substantive procedures. So property, plant and equipment is usually material in amount: buildings, cars, machines, factory, large amounts, millions of dollars for many companies. And it's very important to audit this carefully because you could have large mistakes in there. You have two types of engagements as auditors to audit the property, plant and equipment. The first type is recurring engagement, meaning you audited this client last year, so you're doing it again this year, right? And in this case, you have audited everything until the end of last year. So let's say you audited the client's financial statements for 2019. That means all the balances and items in the 2019 balance sheet is fine. So what you have to worry about now is when you're auditing the 2020 financial statement, you have to worry about what was added, what equipment and property and plant was added, and then what was retired, meaning either sold or donated or any other way it was gotten rid of, what was taken off of the balance sheet. So these are the two. If you're doing this client again this year, you did it last year. If it's a new client, if it's a new engagement, then you have to verify the assets that make up the beginning balance. Now understand, the company may have had a predecessor auditor, right? Predecessor auditor. The predecessor auditor is the auditor that audited the company last year, and you are the successor auditor, right? You're the successor auditor. So you can ask the predecessor auditor for clarification, for information, and usually the predecessor auditor will be very cooperative. And you may have people in that company, in that firm, that are from your friends and ex-co-workers, etc. So usually, firms are very friendly with each other and they help each other out. So you can ask a question or you can send an inquiry, you can ask for a report, and that makes your life much easier than if you were to investigate and discover something yourself, right? So for a recurring, for a new engagement, this is something that is almost always done, right? You have to ask the predecessor auditor, and the client will also provide you with information, but you have to see whether the beginning balance at the year is something that you are comfortable with, and you rely on the predecessor auditor's work as well, right? You trust that the predecessor auditor has done a good job, unless you know otherwise, okay? All right, now the types of transactions you have are: number one, acquisitions, meaning you get the new asset, the client gets the new asset. The obvious way is to get it in exchange for cash, but you can also get it for non-monetary considerations, meaning someone could have donated the asset to your client, right? Or the client may have exchanged the asset for another asset, so exchanging an old equipment for a new equipment. So these are non-monetary transactions, right? The second thing is disposition. So getting rid of an asset. Obviously the client can sell it for cash, the client can exchange it, right? Giving up the old equipment, getting a new equipment. The client could retire the equipment. So the client could retire the equipment, meaning the client can take it off of service. So let's say you're making ice cream with an ice cream machine and the machine becomes slow. It's still useful, but it's not as fast. So you decide to get a new equipment and you temporarily retire this. You keep this as a non-operating asset, right? And if you need to use it later to increase production, additional production, you can use it, but it's not used right now. So this is an example of a retired asset. You could retire an asset that is no longer useful and you can still keep it there, but it is no longer an operating asset, meaning it is not used in the production of goods. Okay. The fourth type is abandonment, meaning it was neither sold nor donated nor exchanged, is just useless, and the client leaves it. So it could be a building that they left, did not sell, it's just there. You find abandoned cars sometimes on the street. Somebody just left the car and never came back, right? So that's an abandoned asset. So the client could, but this is not very common. It is possible. They may have been operating in a country and they had to leave that country and they left the assets abandoned there. So nobody is there, but the assets are there. So this is another example of an abandonment, right? So this is something that can happen. Are you following? Are you with me so far? The third type of asset is depreciation. Third type of transaction is depreciation. You all know about depreciation. You studied the depreciation in intermediate and advanced accounting classes, right? And we are not going to discuss the detailed depreciation calculations, etc. But the transactions include the depreciation. There is a comment here from Sharad that says the difference between retirement and abandonment is too thin. It's not. Retirement and abandonment are two different clear transactions. Abandonment is you no longer have that asset with you. You are at some location and the asset is somewhere else. Retired assets are with you. You have them. If you go there, you can see two equipments. One is working, the other one is not working. And the other one, the client would say this has been retired, but it's sitting there. Abandonment is they had a factory in Africa and they left because of whatever happened. They could not bring anything there. It is in the balance sheet. It was in the balance sheet, but it was abandoned. So now there's different treatment for that compared to a retired asset which can be used again if they want. Is that clear? Yeah, this is clear distinction. Clear distinction. Okay, the fourth type of transaction is leasing. Leasing is basically renting, but if you have a capital lease, that is different from an operating lease. If it's a capital lease where the payments made, rental payment made is so large that it's close to the property value, or it is used for such a long period of time that it is almost reaching the useful life. In those cases, it is considered a capital lease, and you're going to study this if you haven't already in intermediate and advanced accounting classes. If it is a capital lease, then it is on the balance sheet of your client. Remember that. But if it is an operating lease, then it is not on the balance sheet of your client. They just make monthly payments and it is expensed in the income statement. So the details of the accounting you will learn in a different class. But for our purposes, as a summary, capital assets are on the balance sheet. Capital leasing, right? The assets that are leased with the condition of capital leasing, they are on the balance sheet. If they are not, if they're operating lease, then they are not on the balance sheet of your client. Is that clear? All right. Now, the segregation of duties. The initiation of the purchase of the asset should be separated from the final approval. So you remember the initiation, which is the purchase requisition, going to the purchasing department, etc., etc. That should be separated from the final approval for the purchase of the equipment. Reason is, the first, to avoid fictitious, unauthorized, or unnecessary purchases. So there could be purchases that are on paper only. There is no actual equipment. If only one person is doing this, they can hide the fact that nothing was delivered and the payment was made. But if it's multiple people, multiple departments, it cannot be hidden. Also, if it goes through final approval, then there is an authorization and no unnecessary purchases will be made, right? If the equipment is not needed, it won't be purchased if it goes through final approval. Also, this ensures that lower quality purchases are not made, because every single company has a list of suppliers, a list of preferred vendors that are chosen based on the quality and the price offered by the vendor. And if it goes through approval, the supervisor or the approver can make sure that it is only the equipment is only purchased from the pre-approved vendor. For example, we buy all of our laptop computers from Lenovo. So if somebody orders computers from other than Lenovo and it goes through approval, then they could say that we do not buy. What is wrong? Why are we buying from someone else? Does Lenovo not have the computer you're asking for? If they do, then we need to buy from them because they give us a better price and quality. So it reduces the possibility of lower quality purchases. Also, it reduces the possibility of illegal payments to suppliers. So if there is an arrangement with the supplier to make payments, extra payments, etc., then it will be caught because it's done by two different departments, two different sets of individuals. Anytime there is segregation of duty, it reduces fraud and it increases segregation of duties, reduce fraud, and increase accuracy. Okay, remember that. Very good, Faisal. It increases accuracy. Now, property, plant, and equipment records should be separated from general ledger. There are two sets of records. One is property, plant, and equipment record, where you have the purchase order, the receipt, the original warranty, etc., All of those are kept by someone or a particular department. And then the general ledger, where the equipment is recorded in the financial statement. The reason for two separate documents is because if one of these people wanted to hide a theft or loss of asset, they cannot just remove it from the records because it's already recorded in another record. So just by removing it from one record will not delete the record. The company still can find the asset recorded somewhere else, right? So two separate records maintained by two separate departments. The property, plant, and equipment records are also separated from the custody. Custody meaning who has a physical possession of the asset. For example, I have the physical possession of the laptop that I work with that belongs to Qatar University. I do not have access to the physical record where this laptop is recorded as an item with serial number, when it was purchased, what the depreciation is, etc., So now, if something happens to the laptop, I cannot just go and delete it from the record. So I have the physical custody, but the record is with someone else, right? Also, the physical inventory count is separated from the custody and the record keeping. Every year, for every company, there is at least one physical inventory count where every single asset is physically counted. And if there was a theft or concealment of theft, it was stolen and somebody tried to hide the theft, the physical counting will not find that asset while it's in the records. So someone has the asset, I have the asset, someone has the records. A third set of people will come and count all the assets and say, okay, this laptop is in the record. Where is this laptop? This computer, this projector is in the record. Where is this physically present? So if they do that, a third set of people do that, then they will detect any theft or concealment of theft. Is that clear? Now we come to the auditor side of the equation. Inherent risk. The accounting of property, plant, and equipment is complicated. there are many different types of assets, and they all have different lives, right? And it also depends on which accounting method you're using for depreciation, for useful life, for salvage value. Building has a long useful life. Equipment is shorter. Computer equipment is even shorter. So now we have, some digital equipment that have very short lives, and you also have to decide under what amount you're not going to record on the balance sheet and you're going to expense, right? For example, there is quite some time ago, someone working in the finance department of Qatar University told me that below X thousand riyals of assets are not put on the balance sheet and depreciated at Qatar University; they're expensed. So, can you take a guess of that for the for that amount? How much is not put on the balance sheet and it is expensed? And again, this number is specific for Qatar University. This is not something that you can take and generalize to other companies. But do you know what is the rule at Qatar University? That if the cost is less than this amount, it will not be on the balance sheet. It will be expensed. Anyone take a guess? 3,000? Anyone else? It's 20,000. Okay, so anything below 20,000 is not recorded on the balance sheet. This was the case a few years ago. I don't know if it has changed or not. It can change, but this is what it was when I discussed the matter with someone working in the finance department. Complex issues involve lease accounting. I told you about the capital and operating lease, so there could be a difference between the auditor and the client. Also, there is an issue of self-constructed asset. If you buy something and you pay $1 million for it, you can record it easily. But if you self-construct it, it becomes difficult to account for it because you have built it over a period of maybe a few years, and you have to keep track of how much was spent. Just think of this simple example. If I were to ask you to buy a sandwich from the restaurant and I ask you how much is the sandwich, you could say it's 10 riyals because you paid 10 riyals for it. But if you make one at home, and if I ask you what is the cost of it, it would be very difficult for you to calculate that because you have to calculate the cost of 2 slices of bread, 1 slice of cheese, the meat, the ketchup, the mayonnaise, the tomato. You see how difficult it becomes to calculate that, right? So self-constructed assets are difficult to calculate. It's complicated. Also, there are other difficult audit transactions such as donated assets. So if you buy something from the market, it's very easy. Somebody donates assets to you, or you exchange it for another asset. To figure out the fair market value of those assets, it could be complicated, and there could be disagreement between the auditor as well as the client. There could be disagreement between the auditor and the client, right? And then, of course, you have misstatements that were detected in prior years are always an issue, right? If you find a mistake in the previous year, this could be an issue as well. Are you following? Okay. The last thing we're going to discuss today are substantive analytical procedures. Property, plant, and equipment and depreciation expense is looked at and it's compared with the prior year balance to see how different it is. If they added assets, you would know, and you would also know that the depreciation expense would also increase if they added assets, right? Unless they retired assets as well. Okay, so again, this is not a specific test, right? Substantive analytical procedures are not specific tests. So I want to make sure that you know this clearly. So when you sit in that interview and the interviewer asks you, is substantive analytical procedure a specific test? And you can sit there and say, no, substantive analytical procedure is not a specific test. It just gives an indication of a possible misstatement, There could be a misstatement, there could not be a misstatement. We don't know by doing substantive analytical procedure. We have to do specific tests to be sure. This is a beautiful answer. If you can give this type of answer, they would know that you actually have studied auditing and you know what auditing is. Your material, right? Whereas you're sitting there and somebody asks you, what is the difference between substantive analytical procedure and substantive procedure? You scratch your head and you go ooh, and then you say, I'm not sure, but probably not much difference, right? Because substantive procedure, substantive analytical procedure, one extra word, what's the big deal? You follow what I'm saying? This is not what I would like for you to do. Am I able to get this message through to you? You follow? Interview is the main test, right? The final exam, whatever you do, if you get an interview, that's the main test, right? If performing well in the interview is the main test. Once you get in, you can learn how to do the work. But if your interview performance is not well, someone else will get the job while they may not be as intelligent as you. Are you following? My students, my children, are you following? Am I able to get this message to you? Yes? Okay. We also look at the ratio of depreciation related to property, plant, and equipment. So what is the portion? If you have all 10-year assets, if all the assets have a 10-year useful life, then the depreciation would be 10% of the total property, plant, and equipment, roughly, given they use straight line, right? So again, this gives you an indication, not necessarily a specific answer. Also, we look at the ratios of repairs and maintenance to property, plant, and equipment. The ratio of repairs and maintenance tells us whether they have recorded too much or too little in repairs and maintenance. Sometimes some items are recorded as repairs and maintenance, but they are property additions. For example, your client may have added a bathroom to a floor and they have recorded that as a repair and maintenance expense, but it is not. It is addition to the building, because it increases the value of the building, it increases the quality of the building, etc., etc. So it has a longer useful life. Whereas if they fixed a shower or fixed a sink, right, then that is repairs and maintenance. So you need to see whether the repair and maintenance expense is reasonable, and you can look at that by comparing it with previous year as well as the industry average. Same holds true for insurance expense. Again, looking at the ratio and property, plant, and equipment. Usually property, plant, and equipment are insured by most companies. So you want to see last year industry average to make sure that it is in line, it is reasonable. And the last thing to look at is capital budgets to actual. So whatever they budgeted that they're going to spend for buying new assets, and then what they actually did. If they're close, things are most likely working well. If they are very different, that doesn't necessarily tell you that there is something wrong, but there is a question mark. So remember, when we are doing the substantive analytical procedures, they raise more questions than they answer, because you're not looking for specific answers. You're looking for issues that you might find when you're doing what? Issues you might find when you're working on what? Substantive procedure. Very good. Substantive procedure is, well, fill in the blank. Substantive procedure is what? Test of details, which is the audit. Ali, ahsant. Substantive procedure is the audit. It is the audit. Everything we do before the substantive procedure is to figure out how much substantive procedure we're going to do. Everything we find in the substantive procedure is going to decide what our opinion is going to be. So substantive procedure is the heart of the audit. It is the audit. Okay? Am I able to teach you anything from what auditing is? Do you have any questions? Okay, alhamdulillah. Very good. The quiz password is 2050. Take the quiz and I'll see you inshallah on Sunday. Assalamu alaikum wa rahmatullahi